A very good morning to all of you all. Welcome you all to the next lecture of the JC Connect E series of online lectures. Apurva, please off your mic. Yeah. So we have completed the first module, all the theory is done and the problems are done. So from today's class onwards, we'll be starting with module 4. So the good thing about this module is it's conceptual, and from exam point of view, this module becomes very important. So for your internals, I'll be giving questions from module 1, theory as well as problems, and only theory questions from module 4. So module 4 consists of working capital cycle, working capital management, financial statements, which includes balance sheets and its components, profit and loss account, fund flow statements, financial ratios and their importance, project appraisal, project yield, taxation, and inflation. So these are the contents of module 4, which we'll be covering up to this week and next week. So in today's class, let us start discussing with the working capital. Introduction. Working capital typically means the firm's holding of current or short-term assets such as cash, receivables, inventory, and marketable securities. These items are also referred to as circulating capital or short-term capital. Corporate executives devote a considerable amount of attention to the management of working capital. In short, working capital is assets minus liabilities. So now these are financial terms. When they come in, understanding becomes a bit difficult or a bit tricky as we are not used to these terms. So in short, working capital is that money which is required to keep up your day-to-day activities running smoothly. So working capital in easier terms can be defined as that amount of money or cash in hand which you require for the day-to-day works to go on smoothly. In short, it is your working capital. Now, why does the working capital become very important is working capital directly impacts the condition of working of a company. Now we can take small examples also. Now, if I take a student's example, few of you all are staying outside. Okay, you're not in home. If you are in home, your working capital requirement is less. But if you're staying outside, right from the start of the day, you'll start spending money. It starts with the morning breakfast, then you're traveling. If you're traveling by private vehicles or using your bike, you need to fill the petrol. Okay, then again breakfast, all those things which happen throughout the day, you need to spend cash. Nowadays, cash is not required in a hard form because we can scan and pay anywhere. But if you don't have that money, your day's working affects, and that is what is working capital. For example, you want to fill petrol or fuel in your bike or vehicle, and if you don't have the required cash, so you have to compromise. So that affects your day-to-day life. Okay, that is what is working capital. So when we take examples of big industries, this working capital management itself is a huge task. Now, if you talk about civil industry, working capital also plays a very important role because there are few material requirements or any other liabilities which arise at any time that is unplanned. So to satisfy those things, we need some money in hand, which we term it as an working capital. So working capital, we also term it as circulating capital or short-term capital. So that money you require for one day, that's it, or that particular period of that exercise. So that is why it is referred to as short-term capital or circulating capital. Now, working capital and its requirement itself is a big case study. Okay, so if you analyze any construction firm and its working capital cycle, you will get to learn many things. So now we come across two terms regularly: assets and liabilities. Assets is what you have, what you can use, you need not spend on it. Liabilities is such a thing wherein you need to spend and spend and spend. Okay, so always you have to balance between your assets and liabilities. Now, traveling requirement. So if you have a four-wheeler, which will give you comfort of traveling, but it becomes a liability because daily you have to fuel it. Okay, fuel it and refuel it. So it's a liability because that particular asset, that is your vehicle, is leading to a liability. So you're staying in a rented house, paying a rent becomes a liability. If you have gold, it becomes an asset. If you have fixed deposit, it becomes an asset. If you have money in hand which you can spend, it becomes current asset, which will be a part of your working capital. So the entire game of finance is between assets and liabilities. If your liabilities increase and they become more than assets, your firm goes in loss. If you have sufficient assets to satisfy the liabilities, you are doing well. If you have more assets, then you have more opportunities to invest those assets and grow your business and take the profit ratios to a higher limit. So this is what is assets and liabilities and its importance in working capital. So in short, again, working capital is that money which is required to carry out your day-to-day activities. Now, taking example of different sectors, the working capital goes on changing. Okay, working capital goes on changing, but we, from a civil engineering point of view, we got to concentrate on civil engineering sites. We can take a simple construction site or a road work site, okay, and analyze how working capital requirements are there and how they change. So moving further, we have something called as working capital cycle or operating cycle. So this is a general cycle wherein starts with cash or credits or money. By that we purchase the raw materials. By that the work starts. We get the finished goods. Those goods are sold. We get the accounts receivable, which is again converted into the form of cash. And this working capital cycle or operating cycle continues. Now, if we take an example of a civil industry, say we have cash, we get the raw materials, which include our regular materials, which is aggregates, cement, bricks, steel, and all the other things. Plus, by after that, we start our work, then we finish our work, we sell that construction, we get the amount. So it is quite simple. So work in progress means it includes all the things. It includes your labors and money spent for the labors, everything. Finished goods here is your ready home, okay, which will be sold and you will get back the money, which will be again converted to cash and your next cycle starts. So working capital cycles again change with business to business and firm to firm. So now we are seeing currently, as the lockdowns are going on, those vegetable vendors and all, they go to the big market in the morning, they take limited amount of vegetables so that by 10 o'clock maximum is sold. So their working capital cycle is just of 3 to 4 hours. Morning they are putting the money, within next 4 or 5 hours they are getting back their money. They are removing that money which they have invested, remaining is their profit. So business to business, this working capital goes on changing. Shorter the working capital, you will get the accounts receivable early. So what happens in civil projects is managing working capital cycle becomes very important, because if the working capital cycle gets delayed, what happens is this part, that is the account receivables, are delayed, and once account receivables are delayed, you will not get the cash in hand and your next cycle won't start. So many times it happens with the people who are in contracting, their money keeps on flowing in cycles only. They get the money, the profit is yet to come. What money they get, they invest in next project. Again, they are getting the money. Till then, somewhere one part of the profit of first project comes in, that becomes their asset. Okay, so you got to plan such that your working capital cycles are as fast and as small they can be, so that you will get the accounts receivable at the earliest. Because if you extend the cycle with the impact of time value of money, say 10 lakh of rupees which you are supposed to get today, if you get after 6 months, that 10 lakh doesn't remain 10 lakh, that 10 lakh has a lower value. So this is what is a working capital cycle. So it is a cycle in which at all the stages your capital is involved, that is money is involved, and it starts from cash receivables and ends with again the cash. So this is your working capital cycle. So now the factors determining working capital. So we have four factors broadly classified which determine the working capital. One is industry demand and nature of the industry. Yes. Now, industry demand. For example, if we take a part of civil industry, so if we take the crisis of sand, in between there was crisis of river sand, availability was very less, and at that time what happened is we needed sand. So we procured the sand somehow legally or illegally to for an higher rate. At that time what happened, suddenly the working capital requirement changed or working capital requirement increased. Now recently in steel industry, suddenly the rates of steel have escalated. So without steel your construction cannot go ahead. You got to purchase the steel. So what estimates were done 1.5 year or 2 years back have collapsed very badly. So this is what is industry demand and nature of the industry. So sometimes some industries are seasonal. During the season, the rates are high. During off season, the rates are low. So your purchase department should be very much smart enough to make the purchases. They should be in touch with the share markets. They should be in touch with the rates of various materials, because the few things in civil industry, without them we cannot go ahead, and that is what is industry demand. Next is production cycle and sales. So faster the production cycle, faster your sales, better is your working capital. So slower your production cycle and lesser your sales, it affects your working capital. So production cycle becomes a very, very important unit of your working capital. Now, because of these lockdowns and all, what has happened is many of the construction works have stopped. And as those construction works have stopped, okay, the production cycle is derailed and automatically the sales will be affected. So last year I had did a project of a building which was just in my neighborhood. The impact of lockdowns, how lockdown has affected the timeline of the project, and using your project management techniques and Primavera, what factors we can control and get the completion of the project completion time as near as possible to the old one. So production cycle handling will become your responsibility entirely as an project manager. So you delay the production cycle, your working capital gets affected. So next is current asset requirements and credit control. So current asset requirement. So this is also very, very important, because current asset is that thing which you need to pay at that time. So for example, you climb a bus, you're traveling from one place to another place. Conductor is your relative, done. Okay, but can you say that I'll not take the ticket now? No, you cannot say that. Okay, it's a silly example which I'm giving. That is what is current asset requirement. At that moment, you got to pay. So these such things you got to keep in control by managing the credits. You purchase the cement dealer will give you the bill. So now you have to understand whether it is required to make the full payment at that moment only or no. If you make the full payment at that moment itself, what happens? Your working capital requirement increases because you are making a full payment. So in that case, you can use the credit control. So you can pay, say, 25% or say 50%, you can 50%, you can keep as credit. So what happens? As you lower your current asset requirements, you'll have more money to play with in hand. And always money in hand is very, very important in economics. So current asset requirements has to be managed. So sometimes what happens is we try to be too good, okay, and that is not beneficial in our civil industry. You got to have some credits. If you just go on making the payments, what happens is you'll come across such a criteria where you have to pay compulsorily, and that time you will not have any working capital in hand. So as a construction technology expert or a construction manager, you should be able to balance the current asset requirements and see that your current asset requirements don't change a lot. Okay, so current asset, if you're able to manage, you will be a successful project manager. So that is what is current asset requirements and credit control. Then last thing comes inflation or price level change. Now these things many times they are not in our hand. They depend on various factors. For example, now what has happened is for many days laborers will not have any job. Okay, so next once the job starts or work starts, they might hike their charges. Okay, the labor charges might be high. Now, for example, if you're paying a labor 500 rupees per day, he might demand 550 rupees. Okay, so these are the price level changes which will matter a lot in working capital. And in civil industry, at least, this plays a very, very important role. Now, change in technology. Okay, change in technology has some part to play in our civil industry, but this is more affecting in the electronics industry. In civil industry, especially in our country, the technology is not changing that greatly. What we were seeing 25 years ago, still same practices are followed. Now, few things have improved. That's it. For example, now if you take painting, instead of brushes, now the rollers are used, or now we are getting the robotic painting machines also, which will help you all in painting. Now, such things, if you want to introduce, automatically the expenses what you'll have to bear will increase. Okay, so change in technology becomes one more factor, which as of now is not that greatly impacting civil industry or smaller projects. But if you go to bigger projects, getting new machineries or getting expert technicians or maintaining those machineries and all becomes a part of working capital and its determination. So these are the four factors which are very important to determine the working capital. First is industry demand and nature of industry, production cycle and sales, current asset requirements, credit control, inflation, and change in technology. So next is types of working capital. So this will be a question. This has been asked in the university exams also. Working capital. So we have two concepts here, balance sheet concept. Now, what is a balance sheet? Many of you all might have an idea. This concept we'll be studying further in the module balance sheet. And second, in operating cycle concept. So few industries go ahead with the working capital management using balance sheet concept, which has gross working capital and net working capital. There are only two criteria in this concept. Whereas when we go to operating cycle concept, we have permanent or fixed working cycle, temporary or variable working cycle, and in permanent we have regular and reserve. In temporary we have seasonal and special. So there are two concepts on which the working capital cycle is based. One is balance sheet concept, which has gross working capital and net working capital. So if you know your requirements very well, if you know the things very well, that gross working capital and net working capital are sufficient. But if your industry is vulnerable industry, it changes a lot. It depends on season. It has some expenses which you cannot account for. Then you go with operating cycle concept. And our civil industry suits in this operating cycle concept because we have a lot of changes happening in the civil industry day-to-day basis. And that's why we require an operating cycle concept in our civil industry. The other concept is balance sheet concept, which we may apply or we may not apply. So in balance sheet concept, gross working capital. So current assets in the balance sheets of a company are known as gross working capital. So current asset means currently what the company has in hand. Now, if you are there, if you remove your purse, what money currently you have is your current assets. Okay, so gross working capital is nothing but the current asset. Current assets are those short-term assets which can be converted into cash within a period of 1 year. So if you have a land and you're sure that you can sell that land within 1 year, that becomes your gross working capital. If you have gold and you can sell it surely within no time, that becomes your gross working capital. So if you have shares, okay, if you have bonds, which you can sell it out at any moment, that becomes your gross working capital as per your balance sheet concepts. So balance sheet concept doesn't go in a much broader way. It tries to restrict the things in shorter ways, and it has only two sub classifications. It is very difficult to ascertain the exact time of conversion of such assets. Now, if I give an example, I have a land, I want to sell a land. So many of you all might have experienced this. You have a land and you want to sell it also, but we feel it is very easy. Okay, but it's not like selling vegetables that easy. Okay, if you have a piece of land, you have all the papers registered on your name, everything is clear, but still selling the land is a difficult task because you have to get a person who is ready to pay the correct amount. Now, how he will be paying the amount, how much advance he will be giving, what date he will be giving the entire amount, and sub-register office work, okay, transferring that land from one name to another. So many things will be involved in this. Okay, so you are not sure that yes, tomorrow I'll sell that land and get money. No. But in some cases, such as gold and all, if you have your receipts kept properly, selling gold will not become that big issue. Okay, but selling land can become a issue. So again, few things of the gross working capital we can get it easily at any time which we want, but few things of gross working capital it may take a period of 1 year. So this is what is gross working capital. Net working capital, it is the difference of current assets and current liabilities in the balance sheet of a business. Now, if we have read a balance sheet now many times in the newspapers also, at the end of financial year, big companies give their balance sheets so that all the stakeholders know where is their money coming and where is their money going. So the net difference between the current assets and current liabilities in the balance sheet of a business is the net working capital. Net working capital is a part of current assets which are indirectly financed by long-term assets. Now, this is very important. Net working capital is that part of current assets which are indirectly financed by long-term assets. Now you have a FD kept for 5 years, and in that FD you have an option of getting money monthly, okay, or getting money yearly. So that becomes here a net working capital requirement which is satisfied by long-term assets, because your FD is for 5 years. But what money you are getting from that FD or what interest you are getting from that FD, you can give the instructions to the bank that I want that monthly. So for example, say if you make a FD of say 50 lakh rupees at say rate of interest 7%. So 7% means we'll be getting 3 lakh 50,000 per year. So 3 lakh 50,000 per year you can divide by 12 and you can instruct the bank that monthly you put that in my account. So here what is happening, your net working capital requirement is satisfied by long-term asset. Or say you have leased out your land for 10 years and yearly he is giving you a lump sum money. So that again becomes a net working capital requirement which is satisfied by long-term assets. So compared to gross working capital, net working capital is considered more relevant for effective working capital financing and management, because this is sure those are your long-term assets and they will be giving you money as and when required. So net working capital carries more weightage in balance sheet concept. Now we come to the part wherein we require our own things. Operating cycle concept, permanent/fixed working capital. Value of current assets is constantly changing and it is difficult to accurately forecast the value at any point of time. To simplify the complexity to some extent on the basis of past trends and experience, we can find a level below which the current assets have never gone. The current assets below this level are called as permanent or fixed working capital. Okay, so to tell this in an easy way, that is the bare minimum requirement you will need to have. Okay, that is the bare minimum requirement. For example, you have started a site, okay, work is going on, and you know that every Saturday, generally in this part, we pay the bills of the laborers every Saturday. So there are 10 laborers, and for making the calculations, you know that some XYZ amount you have to give. Okay, so in any case, that becomes your fixed working capital requirement. On Saturday, after the work closes, you have to pay that amount compulsorily. So that is the fixed working capital. So materials you can come on credit or some other things you can get on credit, but the labor wages got to be paid on Saturday. Otherwise, you'll find a reaction in the next week. So that becomes your fixed working capital. So always in the operating cycle concept, it says that you should properly have a knowledge of your fixed working capital. Now you yourself also, when you're staying outside, you can analyze what is your fixed working capital or which is your permanent. And below it, your expenses will not come in any case. Okay, below it, your expenses will not come in any case. That is your fixed working capital. Now, a mobile recharges, we know after 3 months we have to recharge, or someone has a postpaid connection, someone has a prepaid connection. So postpaid connections, that bill will come on that day. That minimum, how much it will be, you know it, that much you got to pay. or else you'll get a grace of few days and your connection might be temporarily suspended. So that becomes your fixed working capital. You require a cylinder, gas cylinder for cooking. That is sure that you will require after 1 month or 2 months, depending on your use. So that becomes again your fixed working capital. That is bare minimum. So a newspaper, say if you want, one day you can get a newspaper. Next day, if you don't want, you don't get the newspaper. So again, that becomes a temporary requirement. So it may come as a part of fixed working capital or it may not come. So such things you should understand and note down in civil industry. Last year, when we had this concept, I had given assignment on this to list down the fixed working capitals, or say based on your operating cycle concept, taking a civil industry site, you have to list down all the working capitals which are there. So if you are willing to do it by interest and submit it, I'll be very happy. So operating cycle concept you take an example of an ongoing construction site, say any building or road work, and classify different things under these criterias. Next is regular working capital. It is the permanent working capital which is normally required in normal course of business for working capital cycle to flow smoothly. Next is reserve working capital. It is the working capital available over and above the regular requirements. Now, somewhat your regular working capital and the last one which was discussed is same. So regular working capital means we can associate it with the materials. Now you have an business of transportation. You know that this much of fuel will be required. That is regular. But how much, it depends on that daily variation in the fuel cost. But that is your regular working capital. Regularly you'll require how much depends on the situation. If your vehicles are running more, you might require more fuel. If your vehicles are running less, you might require less fuel. But that comes under regular working capital. You need to pay it regularly. Then next comes the reserve working capital. So again, this is the extra money above your working capital, regular working capital. It is kept as contingency funds, which may arise due to unexpected situations. So if you are excavating, okay, excavation work is going on, and some important part of your equipment gets spoiled. So you cannot say that I'll stop the work. Your machinery is there already. Labors are there. So at that time, what you have to do, you have to use the funds from reserve working capital and get it repaired or changed and continue your work. For such works, you don't have any prediction. So those are called as contingency funds. So that comes under reserve working capital. Next is temporary variable. So difference between net working capital and permanent is termed as your temporary or variable, because these things will keep on changing. Seasonal working capital. Yes, it is that temporary increase in working capital which is caused due to some relevant season for the business. Now, generally in civil industry, we don't get this particularly, or say at a smaller level, when you are casting a slab of a residential building, you get some extra laborers who are specialized in that slab work casting. Your regular masons don't do that work. Okay, there is one more separate type of masons, that smaller level. I'm talking about, say, apartment buildings and all. But if you go to higher constructions, they have their entire team. So when you talk of smaller constructions, you have to get a specialized team for casting of a slab. So we cannot use that word directly, seasonal working, but it is exceptional working. So these seasonal workings and all will come in sugar industry, wherein during the sugar season, you require more laborers, or it comes in other industries wherein the things are manufactured during a particular season only. So at that time, your working capital requirement increases, which is termed as seasonal working capital. Normally, the working capital requirement would increase in that season due to higher sales in that period. So operating cycle concept, the next thing is special working capital. So it is that rise in the temporary working capital which occurs due to a special event, which otherwise normally does not take place. So special event means you're planning a meeting. Okay, you're planning a meeting, the higher level officers from the company are visiting it. So you have to make arrangements for their stay, book an hotel, okay, or arrange a seminar hall where that meeting will take place and take care of them. And also this is a special working capital. So it doesn't happen regularly. For example, now say if a World Cup is organized in a country, or say now Olympics, which is supposed to be organized in Japan. Okay, so these are all special events, okay, which comes once in a while. So special working capital required for this will be required for this. Okay. So now this again depends on the smartness of the project manager to analyze what special events can take place nowadays. Now because of the corona vaccination camps are organized. So many corporates are purchasing huge amount of vaccines and giving it to their employees. Now it becomes a special event. It is not that daily they'll keep on giving vaccination. No, it doesn't happen. It is happening under special circumstances. For that one special budget needs to be approved, and such things are called as special working capital. So in case of civil industry, these things may occur or may not occur, but you need to have a view that such things are there. So the capital required for this is termed as special working capital. So it was a completely theoretical class, and as you many of you all don't want to answer the questions, okay, and you're happy when the questions are not asked. So what I have done in today's classes,